With the exception of the energy sector, the month of July was extremely green on the stock market, which might have you wondering, where did all the dividend stock discounts go? Well guys, in today's video we'll be talking about 3 of them, all of which offer high yields to give your dividend income one heck of a boost. So without further ado, let's get into it. Alright guys, now just so you know my criteria in choosing the 3 stocks on our list to talk about today, I'm pretty much looking for 3 things. Number 1, I'm looking for a negative share price performance. At least in the last 30 days, I want to see that share price going down. I want to see these stocks getting more affordable. Which leads us to number 2. The second thing I'm looking for is an overall attractive valuation. And all 3 stocks we're talking about in today's video have single-digit PE ratios, so they should be pretty cheap. And the third thing I'm looking for, obviously guys, are solid dividend stats. Now, I mentioned in the intro that all 3 companies we're talking about today have really high dividend yields, all above at least 4.5%, and all of these have a really solid consistency as well. Each one of these 3 companies has been paying their dividend for no less than 38 consecutive years. All right, now with that behind us, guys, moving on and getting into the first stock on our list to talk about today that I think is going to be good to pick up in August. We're talking about AT&T, ticker symbol T, who in the last year is down 13%. Really not had a great year, and a lot of these losses in the last year have actually come in the last month where they're down a lot, 8.37%. And even so, as you can see from this share price chart right here, a lot of the losses in the last month happened on one day, on July 21st, which actually, fun fact, happens to be my birthday. But on July 21st, AT&T reported their quarterly earnings, and it was not great. And it had the share price of this company drop 7.62% just in one day. Now, the big hiccup that came out of this earnings report was a lower expected guidance for their free cash flow, which they are anticipating is going to be down to $14 billion from $16 billion. And there's a couple reasons for this. I'm sure many of you out there already know this because it happened nearly a week ago, but they are using more of this free cash flow to reinvest into the business, put that more towards promotions and acquiring new subscribers, which is actually working. And this is one of the good things that did come out of the earnings. They added a lot of new customers in the last quarter. So they added 800,000 postpaid phone subscribers and 300,000 fiber internet subscribers. Additionally, the company said that their net debt fell by $37 billion compared to the first quarter of the year. A lot of this actually was probably a result of spinning off Warner Brothers Discovery, and this is the first earnings report to come out since spinning off that into the new company. Additionally, another positive piece of news coming out of the earnings report is just the high-level stuff. They beat on revenue, they beat on earnings, so overall things are looking really good, but this lower expected free cash flow seems to just be overshadowing everything. But if you have a long-term mindset, if you plan to hold AT&T for a long period of time, this is actually a really good thing in the short term, and we talk about this all the time. You guys know the reason why, because when that share price comes down, it makes the stock cheaper to buy, number 1, so you can get more bang for your buck and pick up more shares for less money. But number 2, the lower share price pushes that dividend yield up, and it means that you have a greater cash flow return on your investment. It's especially why we buy a company like AT&T, which is really not a high-flying, fast growth company. We really are buying it more for that steady, stable dividend income, which it tends to provide, which we'll talk about in just a moment. But before we get there, guys, let's touch on the valuation, which is getting better over time. Now, as you can see, Seeking Alpha gives them a really nice valuation grade of an A-. That's really sweet. And taking a look at this forward PE ratio, that's sitting at 7.38. So in the single digits, very nice. And this happens to be 57% lower than the sector median PE ratio. So compared to a lot of the other companies out there in the communications sector, AT&T is sitting at a relatively bigger discount. And the same is true compared to its historical 5-year average. It's 22% lower than the company's 5-year average PE ratio of 9.46. So all across the board, AT&T is looking to be at a really nice valuation right now, which definitely makes it a tempting buy. Now, going over to the dividend stats real quick, this company has a really high forward dividend yield, sitting at 5.87% with a payout ratio that's not too shabby, 55.5%. And moving on, we do see a negative 5-year growth rate and 0 years of dividend growth. But guys, this is no surprise. When they spun off Warner Brothers into Warner Brothers Discovery, you guys know this already. This is old news. They cut the dividend, reduced the dividend. So that's why we're seeing the negative growth. But they do have some really solid consistency in terms of paying the dividend, 38 years of consecutive dividend payments. So that is pretty reassuring, as you know, from an investor standpoint, I think. Now, just so you guys know my plans with AT&T, I am holding strong, guys. I'm hanging in there, but I'm not quite adding any more to this position right now, but the only reason I'm not adding more to my position is because I already have so much. AT&T right now is one of the top 5 biggest positions in my portfolio. If I didn't have as big a position, I would most definitely be like stocking up on this stock because, you know, like I said, it's just so freaking cheap. All right, guys, I'm moving on to stock number 2 that I think is going to be a good one to pick up in August. We're talking about Walgreens-Boots Alliance, ticker symbol WBA, which is a pharmacy and drugstore chain here in the United States, which I'm sure many of you are aware of already, seeing as apparently 78%, yes, 78% of the US population lives within 5 miles of a Walgreens. That's pretty impressive. What's also impressive is how poorly this stock's share price is performing. Now, year to date, they're down over 27%. In the last 30 days, they're down another 3.5%. So Walgreens is going through a tough time as far as share price performance goes. And really, guys, truth be told, they're getting it from every sort of angle. And all year, this company's been in the news with some not so great headlines. Starting with this first one, guys, that reads, Walgreens reports decline in third quarter sales amid waning COVID impact. So this company was a pretty big beneficiary of the COVID pandemic. Okay, they gave out a lot of vaccines, which definitely boosted their sales. So they're starting to lose that short temporary boost they had in sales from the pandemic, which is to be expected. The second headline has to do with their Boots chain of stores, which is basically the UK version of Walgreens. And this headline reads, Walgreens falls after sale of Boots UK chain terminated. So they're having a hard time getting rid of, parting ways, and selling the Boots chain of stores. They can't seem to find a buyer right now. I think they had a couple potential buyers lined up, but as you guys know, the economic environment is starting to change, which maybe will make buyers not as eager to pick up this chain of stores right now. Now, moving on to the third and final headline I wanted to share. This is really not a good one. Walgreens goes to trial in Florida over its role in the opioid crisis. And one person in this article even went so far as to say, or to quote, it was the entity, Walgreens was the entity that actually put the opioids in the hands of people addicted to opioids and in the hands of criminals. Definitely not something you want attached to your company. Definitely not something you want attached to your brand. So as you can imagine, that's not a good look for Walgreens. And the combination of these 3 things, as well as some other things we could probably draw up, is pushing the share price down, which like with AT&T, this is a good thing in the short term if you have a long-term mindset with the companies that you're investing in. It's definitely making the stock cheaper and it's making the valuation better. And like with AT&T, Seeking Alpha gives the valuation for WBA an A-, a really strong grade, and the forward PE ratio is looking sweet. 7.63, which is about 57% lower than the sector median PE ratio and is about 25% lower than the company's 5-year average PE ratio. So all across the board, Walgreens, guys, looking really cheap. And this company has some really solid dividend stats to go along with that. As you can see, it has a 4.99% forward dividend yield with a pretty low payout ratio with room to grow, about 37.4%. The 5-year growth rate's pretty sustainable, just under 5% with 7 years of consecutive dividend growth. But this company does have some consistency with the dividend payment history. And as you can see here, they've been paying the dividend for 45 consecutive years, so a long time. All right, guys, now moving on to the third and final stock of the day. And this is one that I actually included in my list of best stocks to buy in July, and it's making its appearance again for the month of August. We're talking about Altria Group, ticker symbol MO. Now, year to date, this company is down double digits, down just over 10%. In the last 6 months, they're down even more, down 13.73%. And in the last 30 days, this is actually breaking my criteria. In the last 30 days, they're up 2.75%. They're starting to rebound a little bit. And many of you know a lot of the turbulence this company has had with its share price is due to ongoing conflict with the FDA, who is trying to do 2 things to Altria Group. Number one, they've been trying to ban Juul, which is Altria Group's electric cigarette subsidiary. They're trying to ban Juul, remove it from the shelves, make it so Altria can't sell any more of the products or manufacture any more of the products. That's number one. Number two, they're trying to reduce the level of nicotine in Altria's cigarette products to a non-addictive level, basically making it so people can no longer, or at least have a lot harder time becoming addicted to cigarettes. Now, moving on, getting into this company's dividend stats, guys. I say this every time I talk about Altria, but they are a triple threat, or what I like to call a triple threat in the dividend department. As you can see, they've got the high yield, currently sitting at 8.42%. They've got the pretty high 5-year growth rate, 8.09%, and they also, according to Seeking Alpha, they have 18 years of consecutive dividend growth, but Altria Group actually is a dividend king with 52 years of consecutive dividend growth. So they've got the high yield, they've got the high growth, and they've got the dividend growth history, the dividend king status as well. All right, guys, now those were the 3 stocks I really wanted to hone in on for today's video, but there are still some other great dividend stock discounts out there that I think deserve some attention, and that's what I want to go through right now. Just kind of list out a few more stocks that you might want to consider picking up some more shares of in the month of August. So at the top here, we have Scott's Miracle-Gro, which is down nearly 46% year to date. We also have Stanley Black & Decker right here, ticker symbol SWK, which is down nearly 40% year to date. T. Rowe Price, which is down about 38% year to date. Scrolling down, we have Target right here, which is down over 31% year to date. Skyworks Solutions right there in the technology sector, down 30% year to date. BlackRock right here, down at 30% year to date. Dover Corporation, down nearly 30%. Cisco, same thing, down nearly 30%. Whirlpool right here, which we covered in the best stocks for July, really high growth dividend stock, down nearly 30% year to date. They've actually had a really solid month though. Look at that. They're up double digits just in the last 30 days. We've got Lowe's down 25% year to date. We have 3M down 24.5% year to date. We have, let's see if we can get a couple more. Best Buy down 23% year to date, which is another fantastic dividend stock, guys. High yield, high growth, low payout ratio for Best Buy. You can't go wrong there. Anyway, guys, I think that about covers it. And now that you're clued in on some of the best, some of the cheapest dividend stocks to buy in this upcoming month of August, check out this next video right over here, talking about 16 of the top companies that will pay you a dividend in the month of August just for being a shareholder. It's the easiest money you'll ever make. So click right over here and I'll see you in the next one.